Part 1, Cash and Accounts Receivable. Now, there first, when you look at cash, a lot of times you'll see the title, Cash and Cash Equivalents. This would include cash, but it would also include what we call equivalents, which are any short-term investments that are highly liquid and easily converted to cash, held for less than 3 months, called trading securities. Restricted cash is restricted from regular cash and is set aside for specific purposes. Will appear as a long-term investment on the balance sheet. Bank overdrafts, the difference between GAAP versus international standard. Under GAAP, overdrafts can be offset against other accounts if they are all in the same bank. Remember, they've got to be in the same bank. Otherwise, they must be treated as a current liability. Under the international standard, you can net all overdrafts with all your other bank accounts. Now, let's take a look at an example and look at the difference between GAAP and the international standard. In this example, the bank has a cash account, the Cutler Company has a cash account with a balance of $250,000 with a bank, and in another account, a bank overdraft of $10,000 at the same bank. In addition, they have a cash balance of $50,000 with Wells Fargo and an overdraft of $10,000 with Citibank and an overdraft of $5,000 at Low Bank. So, how would this appear on the balance sheet? Now, under GAAP, you would show cash of $290. This would be the $250 minus the 10 plus the 50, and that would get you there. Now, liability would be the overdrafts in the other two banks because they can't be netted against the $290 under GAAP. Now, under the international standard, you just net everything together. So it would be the $250 minus the 10 plus the 50 minus the 10 minus the 5. That's the difference between the GAAP and the international standard. Current liabilities would be none under the international standard. Now, the other thing we can have are trade and sales discounts. Trade discounts we ignore. An example would be in the catalog, it says something costs $100, but if you buy 10 of them, you can get them for $90. If you bought 10 of them, all you would book would be 10 times $90. Sales discounts are different. These are, you get incentivized if people pay you early. So we have two methods here. We have what's called the gross method. You record the gross sale and record the discount if taken as a debit to sales discounts. The net method. We book sales net of discount and credit sales discounts forfeited and adjunct account to sales when discount not taken. So now let's look at an example. A company sells $5,000 on account with terms of 310 net 30. So under the gross method, we would book the accounts receivable at $5,000, sales at $5. Paid within terms, we would show the cash of $48.50, which is 90%. I'm sorry, the $48.50 cash is actually 97% of $5,000, or if we take $5,000 times 3%, we get $150. What if they had paid after the 10 days? Then you would record the whole amount of cash and the receivable at 5. Now let's look at what it looks like under the net method, the same transaction. When the sale is made, they automatically discount the accounts receivable and sales. If it's paid within terms, it's just cash accounts receivable. If it's not paid within terms, it's going to be cash $5,000, accounts receivable $48.50, and sales discount forfeited of $150. Now we're going to look at accounts receivable. There are two ways of treating uncollectible accounts. There's the direct write-off method, which is required for tax purposes but not allowed under GAAP. Okay. So, the write-off, when we use the write-off method, when we actually have bad debt, it will affect both the income statement and the balance sheet, and there is no estimate. We just book bad debt as it occurs during the year. Now, when would you be able to use this under GAAP? If you almost never have people not pay you. But in most cases, if you're a retailer, you're going to have problems with people paying you, and that's why you have to use what we call the allowance method. We set up a contra asset called allowance for uncollectible accounts or allowance for bad debt. Any write-offs of bad debt has no effect on the income statement or the balance sheet. Bad debt is treated as an estimate. Bad debt expense is treated as an estimate. So, also what we're trying to do when we use the allowance method is we want to see the accounts receivable at their net realizable value. So when you see net accounts receivable on the balance sheet, it's always accounts receivable less allowance for uncollectible accounts. Now, when we look at the allowance method, there are two allowance methods. One's called percentage of sales, the income statement method, and the other is called percentage of receivables, but a subset of that would be we could do the aging schedule using different rates. So you could use either one of those, are called the balance sheet methods. Or you can just use a composite rate, which is what you're doing when you age the accounts receivable. The assumption under aging is the older they are, the less likely you're going to get paid. Now we'll look at using percentage of sales. Bad debt expense estimate is always credit sales. Remember, it's credit sales times the percentage. Now, when do you normally use this one? Is a lot of times what they do is use this one during the year, and then at the end of the year use the aging or percentage of accounts receivable at year end. So a lot of companies use both methods. The composite rate based on accounts receivable. Here what you're going to do is take your percentage times gross accounts receivable equals ending balance in the allowance for uncollectible accounts. Now this is different than the percentage of sales method, because when you do percentage of sales method, you come up with the expense and that's your journal entry for bad debt expense. Under the composite rate or percentage of accounts receivable, the balance that you come up with in the allowance account for the allowance account is the ending balance. So you have to adjust for any balances that are already there in your allowance for uncollectible account. So estimate ending balance in accounts for uncollectibles, and then you're going to plus the debit or minus the credit balance in the allowance account, and that will give you your number for estimated bad debt expense. So now let's look at a problem, and we're going to look at the direct write-off. We're going to look at percentage of sales, percentage of receivables, and the aging of receivables. Okay, we have a problem here. The company had a beginning accounts receivable balance of $600,000. During the year, they wrote off $41,000 in bad debt. They had total credit sales of $5 million, and they received cash payments of $4.9 million. What is the journal for writing off bad debt, estimated bad debt, the balance and allowance for doubtful, and net accounts receivable? The write-off of bad debt would be bad debt expense, because when you use the direct write-off method, you use the actual amount written off and you reduce accounts receivable. So in this example, you can see what we're going to do is we're going to increase expense on the income statement and reduce an asset on the balance sheet. So when you use the direct write-off, it always affects the income statement and the balance sheet. when you write off bad debt. Estimate of bad debt, there is none because you're writing off what you actually receive. Now again, this is the method you must use for tax purposes. Bad debt expense equals actual write-offs. Ending balance in allowance for doubtful, there is no allowance for uncollectible reserve when you're using the direct write-off method. Net accounts receivable would be your beginning balance plus your sales minus your payments minus your write-offs, which gives you $659,000. Now let's look at percentage of sales. Percentage of sales, we've got the same problem, and we have to write off bad debt of $41,000. What we would do is debit allowance for uncollectible account, which is a contra balance sheet account, and credit accounts receivable, which is also a balance sheet account, which shows you that whenever you actually write off bad debt under any of the allowance methods, it never affects the income statement or the balance sheet. Now we're going to estimate bad debt. Well, what we're going to do is take 1% times $5 million gives you $50,000, and that's going to be our estimated bad debt expense is $50,000 and allowance for uncollectibles of $50,000. So now let's look at our T accounts. So we had a beginning balance of $30,000 in allowance for doubtfuls, $600,000 in accounts receivable. We had write-offs of $41,000, and we had sales of $5 million, paid $4.9 million, and we had an adjustment to our allowance for uncollectible based on our estimated bad debt expense. And now we're going to end up with an ending balance in allowance for uncollectibles of $39,000, and our accounts receivable is $659,000. What's our net accounts receivable? Remember, it's always going to be accounts receivable minus allowance for uncollectible, because allowance for uncollectible is a contra account, and it's contra to accounts receivable. Now let's look at percentage of accounts receivable or the balance sheet method. Same problem. We would write off our bad debt, again, to the allowance account. Then we would estimate our bad debt, which is 5% of accounts receivable. So what we need to do is figure out what is our balance in accounts receivable, which is $659,000. So in order for us to come up with the amount to book, what we have to do is we take 5% times our ending accounts receivable, which gives you $32,950. But what we have is already is a debit balance in allowance for doubtfuls, and our ending balance must be $32,950. So our bad debt expense is going to be $43,950. And that's going to be our adjustment to our allowance account. And that gets us to that ending balance that we want, which is $32,950. And we have to adjust by $43,950 to get to that number. So bad debt expense is $41,950. I'm sorry, bad debt expense is actually $43,950 because that's the adjustment we needed to get it to the correct balance. So again, whenever we're using percentage of accounts receivable or either one of the balance sheet methods, including aging, what we need to do is when we come up with our estimate, that estimate is always what the ending balance needs to be, and then what we have to do is subtract, or we have to add back in if it's a debit balance and subtract out if it's a credit balance to get the actual bad debt expense. And now our net accounts receivable is going to be $626.50, which is our accounts receivable ending balance minus the balance in our allowance for doubtfuls. Now, aging of accounts receivable. The assumption is the longer it's out there, the less likely to collect. So here would be an example, and a lot of times there are computer programs that do this for you. So we're saying that between 0 and 30 days outstanding, only 5% of those may not be collected. But when we get over 120 days, we're assuming 45% chance those won't be collected. So when we take the amounts times our estimate, that tells us, and we total those up, we're saying of the $659,000 of accounts receivable, we're estimating that we won't collect $40,200, which should be the balance in your allowance for doubtful account. All right, so same problem. We would still write off our bad debt. Now, estimate of bad debt expense, we're saying the ending balance should be $40,200. We currently have a debit balance of 11, which means we've got to add it to the 40,200 in order to get the number that we want in the ending balance. And so now our ending accounts receivable is going to be $659 minus my $40,200. Now, what happens when you write it off and then later on somebody repays you? It doesn't matter which method you use, you always have to reestablish the accounts receivable and then show the payment. Regardless of the allowance method, whether it's sales or aging of accounts receivable or percentage of accounts receivable, we're going to reestablish the account and we're going to credit allowance for doubtfuls, and then we're going to show the payment. And the reason we do this is we need a trail. And that completes this part 1 for accounts receivable.